Today, the story is going to be number one, the tipping point, and number two, we're going to be focusing on labor. So, if you recall, I said that the decline in the ISM PMI report was the tipping point. Now, what I need to warn you about or be prepared for is that just because the tipping point has been reached doesn't mean all the economic indicators are going to rapidly decline. Some are going to go up, some are going to be flat, some are going to surprise an upside. You never know. So this Friday is a big, big day because in terms of tipping point and inflation and what the Federal Reserve is looking for, they look at a few things that are really important. Number one, they look at the PCE, the personal consumption expenditures, but they also look at the labor report. And also remember, the Federal Reserve supposedly has a dual mandate, two mandates. One is strong labor, lots of people working, and two, holding down inflation. But as you know, or probably suspect, the Fed's not really looking at labor. As a matter of fact, the inflation is out of control, so out of control that the Federal Reserve has no other choice but to reduce economic growth. So they're actually going to be looking to reduce labor growth and increase the unemployment rate. But they're not going to tell you that. It's not, because it's not politically correct to say that. So let me go to the videotape here. Let's go to some charts and I'll show you what I'm talking about. The first thing I'm going to show you is unemployment rate. The unemployment rate has been way, way, way too low. And even forecasts show that it's only going to go up to less than 5%. And that's not going to be enough to lower inflation. So that's a big warning sign. So we need to see this labor report that's coming out on Friday to weaken. Second thing I want to show you is why there's so much inflation. If you look here from trading economics, you can see that, and I've got my pointer on here, in this area here, you can see that recently, as of the last year, well, since COVID, there's been a volatility in wages, obviously, because the economy basically shut down, number one. And number two, you can see that there's been a spike in wage growth. And this spike in wage growth is going to take a long time to ebb, to decline, because the economy is too strong. And as I said earlier, I'll show you the unemployment rate's too low. And if you look at personal consumption expenditures, and this is from the Bureau of Economic Analysis, you can see that the PCE has been too strong, and it's not here. Well, I don't have a chart for it, but basically the core PCE has also been too high. So I won't show it to you, but basically it's been too high. And if you separate the two PCEs into a manufacturing PCE and a services PCE, what you're going to see is that inflation on the manufacturing side has been declining, but not on the services side. And so here, what I'm showing you, and this is where I talked about the tipping point for the PMI, but here I'm showing you both PMIs. I'm showing you the ISM Services PMI and ISM Manufacturing PMI. If you remember, I just told you the PCE, meaning inflation, has been too strong, and it's because of the services part of it. And the services PMI just came out, and it was higher than expected, and it's still too high. It's 56.7. We need this to come down. And if you see that both PMIs tend to track each other, but not this time. This time, the consumer is strong, and you could see that in many ways, and I just showed you in terms of unemployment rate, and I just talked about the PCE in terms of consumer, on the consumer side, has been stronger. Now I'm going to talk about something else that came out today, the ADP Private employment. And this too has been too strong. But I think, and I suspect, as I said earlier, we're at a tipping point. And the labor report comes out Friday, and this is from Market Watch. And you could see that 315,000 jobs were created last month, and 275,000 jobs are being estimated. And you can see the titles up here. That's a median forecast and the previous number. So let's go back down. So the median forecast is 275K versus the previous number 315. So the good thing is it looks like economists are expecting a pretty high number. And the expected unemployment rate to remain flat at a very strong 3.7%, and average hourly earnings to be flat at a 0.3% growth for the month. So what I want to say is, if you look here, we talked about ADP Private employment, which has been still strong. You know what? Let me get rid of that chart so we can just focus on job openings. This is what everyone talks about, the JOLT index. James Bianco likes to talk about this. This is a number of job openings. And if you look here, finally, there's been a decline. This is a 5-year chart. If you look at the 1-year chart, you can see there's been a sharp decline. So as I said earlier, we're at a tipping point, and we're going to see job losses and economic growth is going to slow down. So if there's any canary in the coal mine in terms of the job report, it's this. It's this JOLT or JOLT index that has shown fewer jobs. It's still strong. There's still a lot of job openings, but it's shown fewer job openings. If you look at some of the tech companies lately, like Amazon and Facebook and many more, they have been freezing jobs. So maybe they're not hiring, but they're definitely freezing. So I'm sorry, I meant to say maybe they're not cutting jobs, and maybe they don't have restructurings with big job cuts, but you see them freezing jobs, and that's the beginning of what we're going to see in job losses. So just to summarize what I said earlier, let me magnify myself. What I said earlier in the week is that the ISM Manufacturing Index finally hit a tipping point where it's declining. Now we're probably going to get a decline in an ISM Services report next month or the month after, because the services industry and consumer economy has been stronger. So this Friday, we got the employment report coming out, and economists are looking for a pretty strong employment report. But the canary in the coal mine is the JOLT index. We're seeing fewer job openings, from 11 million last month to 10 million this month. So if we get any weakness, it's going to start this month or next month in the labor report. And like I said, the first indication of weakness has been hiring freezes, number one, and number two, what I just said, fewer job openings. So let's see what comes out Friday. And one last thing, just like Steve Jobs said, one more thing. If the jobs report comes in even a little weaker, it doesn't have to be weak, just a little weaker, I think interest rates are going to decline, so Treasury is going to rally, and the stock market and growth stocks like Cathie Wood stocks are going to rally, because this market is like a spring. It wants to go up and it wants to find positive news. And what I'm saying by positive news is meaning bad news is good news. So the stock market wants to find signs that the economy is weakening, and then it'll take off at least for the next few days until the earnings reports come out, and then that's another thing. That's another story. Well, thank you for listening, and please like us and subscribe to us, else we won't be able to continue these videos. Bye-bye.